our speaker who's coming up next has spoke here before, and I was chatting with him earlier in the summer. I said, yeah, I think you spoke last year. Would you be interested in speaking again? Oh, yeah, sure. He was very appreciative of it. And I went back. It was in 2016. I thought, where is all this time going? I had no context for how long ago it's been. So he's back with us again. He's right in a very interesting spot within, again, the technology landscape. I won't attempt to describe it other than it involves things like mergers, acquisitions, financing, investing, very, very cool things in our world, certainly. And Ed Bryant is our guest speaker. Ed, he runs Sampford Advisors. Pause. We have two companies in our ecosystem, Stratford Managers, Sampford Advisors, and I do that dyslexic thing all the time, so apologies to you as well. At least I got your name partially right. So, without further fumbling, bumbling, and ado, I'd like to bring Ed up. Ed Bryant with Sampford Advisors.
And I thought that so much time had passed because you didn't want me back, Steve. So
just lost track of time, Ed.
And before we get started, I do want to acknowledge Wales' win over Australia the other day. So pretty impressive. If anyone's not watching the Rugby World Cup, they should be. It's going to be fun. Okay, so I'm here to talk about capital raising and M&A. It's something that's very near and dear to my heart. Sampford Advisors just does M&A for technology companies. So a little bit about us before we get started. So yeah, just tech M&A. We focus on the mid-market, so transactions of less than $150 million. There's a team of 7 of us. We're headquartered here in Ottawa, of all places. And we've got an office in Toronto and in the US. And then the team's experience is pretty global. A lot of that based on myself from New York, Singapore, Hong Kong, the UK, and Toronto. So we're trying to bring that real big bank experience to much smaller clients. Here's some of the Ottawa stuff we've done. You'll recognize Martello, obviously, one of the Wesley Clover companies. We've done a couple of transactions for them, helping them buy 2 different companies. We've done a transaction for Magor, which was another Wesley Clover company. And we've represented Wylan in its first acquisition of non-IP related, non-related IP company, and a bunch of other stuff. We're working on 5 M&A deals right here in Ottawa right now, and we're doing 12 other deals outside Ottawa. So we're exceptionally busy. Some of this is some of the stuff that we're seeing in the market combined with just overall market trends. It's split into 2 kind of sections. One, venture capital, and then we'll talk about M&A. So maybe if we could split questions, we can stop at the end of this section and ask any questions around the VC market.
Sorry, and if we could leave it till the end, I'll
okay.
use the microphone and
sure.
Walk around the...
Okay. So what's been going on in the VC market? This is just tech related deals. There's 2 things here. The blue bar is the volume of, in dollars, and the line is the number of transactions. So dollar volume peaked last year. It's going to be pretty much similar this year. So very, very good, strong volume in terms of the VC. I think the interesting thing, and we'll get into this in more detail later, is the number of transactions is definitely dropping off. So the most transactions happened in 2015, and it's slowly kind of come down from there, and then this year will be down another kind of 15% from last year. So there's a couple of factors that are driving that, and we'll talk about that. A lot of that, obviously is the deals are getting bigger, but there's getting fewer of the deals. So the money's being concentrated in many more hands. That's meaning as well that the seed and Series A capital raises are really getting hit hard. So in terms of the volume of deals in that bucket, it's much harder to get capital. You can see that here on this chart. So there's 3 bars here looking at both early stage in blue, mid-stage VC in gray, and then late stage VC in red. And actually, like, the late stage stuff in red has actually stayed pretty constant since 2010. The mid-stage stuff has increased nicely, and it's probably due to continue that kind of upward trajectory this year as well. But really, you can see the explosion of the early stage that really happened from 2010 to 2015, where it 4x'd over a 5-year period, and that's the piece of the market that's really kind of coming down the other side of that, right, and almost normalizing. So we're this year we're going to be at probably 35% off of the 2015 peak. In terms of deal sizes, you can see here seed, Series A, B, and Series C. I think the interesting thing here is how quickly things have really expanded. So, back in 2010, the average seed raise was $500,000. It's now $2 million. The Series A was $2.5 million, and now that's 8.2. And that 8.2 today is where a Series B or a Series C was in 2010. So deal sizes are getting significantly larger than they were historically, and you can see that on the late stage deals as well, where we've gone from 8.2 to 30 on a Series C. So much more money going into a smaller pool of companies. And then what's driving some of this? Obviously, this is money going into the actual VC funds. So how big are the funds getting, and how much money are they raising? Back in 2010, they were doing $37 billion of raises for the whole year. That kind of peaked last year at 90 billion. So last year was a really good year. We're not going to hit that level this year. We're going to be at about 3/4 of that. But what it says to me is, if you know VC life cycles, they've usually got about 5 years to invest that capital. So the 2014 stuff and before is pretty much rolling off. It's committed or not being used. And then 15, 16 is pretty late stage stuff. I think the interesting thing for me is there's still a lot of dry powder very early stage. So a lot of money that's been raised, $120 billion in the last 18 or so months, that's still put to work, but they've got a longer window to put it to work. They've still got 3.5, 4 years, 5 years left to put that money to work. And what we saw in 2008 when there was a bit of a slowdown was the VCs just stopped writing checks for 18 months, 2 years, because they could. And I think that same dynamic, it's not happening yet, but that same dynamic could happen if there is a slowdown. They've got the room to be able to delay their investments and really wait for valuations to stabilize and the market to stabilize. So on the VC side of things, a few summaries. Number of transactions is down pretty significantly, especially on the seed side of stuff. Volume is pretty steady. The deal sizes are getting materially larger. And I think we see it a lot in Canada as well. In particular, there's much more availability of that late stage capital in Canada than there is the seed stuff. If we're talking to founders and CEOs, they're having much more harder time at that seed Series A level than they are at the C and D. And the VCs in Canada have moved themselves later stage than they ever have been. So you've got OMAs and others that are doing C's and D's when they used to do A's and B's. And so that is a problem for the ecosystem in Canada. It's being filled a little bit by people like Terry, obviously, on the early stage stuff, angel investors and US seed investors, but it's definitely still a gap that we see and still a pain point for many founders. Late stage capital for proven companies is very abundant and very available across North America. There is significant dry powder. The question is, if there is trouble, do they delay it? And then, it's actually been a really interesting year to watch VC deals. The largest VC deal ever happened this year for a Canadian company at like $500 million raised. So it's interesting to see those little nuggets of good things happening in Canada, but they're small in comparison to the US, which is still a concern. So, okay, my favorite topic is obviously on the M&A side. So there is very similar trends here. So we've been on a real upward trajectory in terms of the dollar volume that's being deployed into M&A since 2010. So we're basically going to be 3-4x the number of dollars being deployed into M&A in 2019 than we were in 2010. So a massive rise. But the similar thing is kind of happening. The deals have kind of dropped off this year and probably going to be down about 10-15% year over year. So not as dramatic a shift as there's been in the VC market, but it's definitely starting to show up in the M&A market as well. So that shows us that the earlier stage M&A stuff is getting harder to do. One thing that we've noticed over the last 4 years since we've been in business here is, maybe 4 years ago, a pure technology sale was actually pretty easy to get done. People were looking to fill gaps on the technology side, and now that is actually a very hard deal to get done. Most people have made their moves that they want to make, or they're doing it internally or whatever. And so that build versus buy equation, it used to be buy and it shifted to build. So that really early stage M&A is starting to become much harder, and it's much more focused on bigger opportunities that are more established revenue. And we'll talk about some of the factors that drive valuation in M&A in a little bit. I like to look at this just to kind of see if there's any material slowdown or acceleration of a slowdown. And this is just the same chart, but on a monthly basis since the beginning of 2017. And it is down a little bit, obviously. Sorry. It is down, obviously, a little bit, but there's not been a material slowdown in 2019. And that was always a concern for me with all the macro concerns, especially the trade war between China and the US. At what point does that uncertainty make buyers sit on the sidelines? And I think some of them are, but it hasn't necessarily really shown up yet in these sort of numbers. But again, we'll talk on that a little bit in the next slides to come. I think this is actually a really interesting slide for me, and one that we've really noticed in our business in terms of who we are selling companies to. So this shows the number of transactions that are completed by private equity versus strategics. And so back in 2010, private equity made up about 20% of technology M&A deals. Now they represent 44%. And so that's been a massive shift in our business. There are so many funds in the US that we talk to on a daily basis that are buying mid-market tech companies, and they're going smaller and smaller in terms of what they are buying. So they still think like private equity, so they want EBITDA or cash flow, but the threshold that they want cash flow is much lower than it's ever been. And as an example, our database is over 400 mid-market private equity guys that we talk to on a regular basis, and I think that's just scratching the surface, to be honest. There's many more. So I think this is a shift that's going to continue. The amount of money that's gone into private equity in the last 10 years dwarfs what's gone into VC. So it's very likely that this trend will continue. So a big question we always get, obviously, is show me the money. What is the valuation? And I like to show it this way to split up the impact of the really large deals, because they really do shift the numbers. So the top line is the 75th percentile, bottom line is the 25th percentile, and the middle line is the median. And we have seen a big jump this year, and that's really pulled up by some of the mega deals that have been happening from the likes of Salesforce and SAP and others that have really been pulling up that average. I would say, in reality, that 4.9 middle bar to 7.5 move is probably not as wild a swing. The market feels just about as good as it did last year. It doesn't feel nearly 2x or 50% better than it did last year. So I would say it's pretty consistent, but the big deals are definitely pulling up the median in terms of the overall valuation. And this is just for SaaS companies. But one thing we see a lot is that size does matter. So you can really see this here on deals. SaaS companies between 0 and 10 million of revenue, the average multiple is 2.5 times revenue. So very different to that prior page where it was 7.5. So, and then you see it gradually increase. You get above 10 million, in that sort of 11 to 50 bucket, it goes up to 3.5, and above 50, 4.5, and I would say above 500, it goes up north of 10 times. So there is a big discount for size. So if you've got a SaaS company that's doing 1 or 2 million of revenue, it's going to trade on the bottom side of this equation for sure, unless there's real synergies on the revenue side of things that a buyer can see that it's much more valuable to them than it is independent. And then we get asked this a lot because while SaaS is the thing right now, not every company is SaaS. There's still a lot of companies out there that are supplying governments or municipalities or whatever that don't buy SaaS or rarely buy SaaS. They're starting to, but very slowly. So there's a lot of companies out there that are not SaaS. And as you would kind of expect, they do trade at a discount. I think this is actually an interesting chart because they trade at the biggest discount that they've ever traded at. A couple of years ago, the spread between a SaaS and a non-SaaS company was, it was there, but it was not as broad as it is today. So this is a gap that we see continuing to widen. Whenever we represent a company that's perpetual license and maintenance model, even if they have scale and very good profitability, there is that herd mentality among private equity right now, among strategics right now. Oh, it's not SaaS, I don't want to look at it. Even if the maintenance revenue, which is recurring, they view that differently to pure SaaS, which is kind of interesting for us to look at. And it truly is a herd mentality, because I would argue that maintenance revenue is probably more sticky than SaaS because you've already paid the upfront for it. You've probably got it on premise. You're not going to rip it out. And you've made a significant investment as a government or a municipality or whatever it is. It's very unlikely or less likely you'll replace it, whereas SaaS is typically 12-month contracts that you can switch to a competitor if you want. So, but it's a very interesting trend, and it's definitely a herd mentality at the moment. So, in terms of overall kind of trends that, to summarize, the market is still strong. I would say that what is not showing up in those numbers is that we do see a little bit of a slowing. We've been talking to a lot of these private equity companies for a number of years now, and we noticed that certain things that we think they would have bought 12 months ago that they're being more cautious about. So especially on the private equity side, there is a lot more caution out there. They're still deploying capital, but they're being much more selective. I think the other thing is it's a very crowded market. So we commonly call companies and they're looking at 10, 20 different M&A opportunities at the same time. And they just can't, therefore they have to be selective with their time and where they're spending it. That is a problem. That is a supply and demand imbalance, and one that usually rectifies itself with price. It's not quite showing up yet, but it is a concern to us that how crowded and how many companies are out there being sold right now. It's a lot. And then deals are taking longer. So we're closing a deal hopefully next week, and it's taken us 12 months. A year ago, it would be 6 months. So our average kind of time to close has gone from kind of 6 to 9-ish months, I would say. And that's some of that crowded market, people being more selective, and us having to turn over a lot more stones to make sure that we get a good outcome for our clients. And then one parting thought on valuation, we see this a lot as well. A lot of commentators out there in the market say that the only thing, well, there's two camps. There's either revenue growth is the only thing that matters for valuations, or Rule of 40, which Rule of 40 is basically the percentage of revenue growth added to your profitability or EBITDA margin has to add up to 40 or above. I would say it's a lot more complex than that. There's a lot more factors that go into a sale and a valuation. And so we've kind of distilled it into these kind of 6 factors. Scale, as we touched on earlier, is really important. If you're doing $1 or $2 million of revenue, the buyers look at it and say, it's not big enough for me to care about it. Have you really demonstrated product market fit if you're only selling $1 million of revenue? That's the pushback that we will get. That goes away, at 5 million of revenue, that complaint goes away. At 10, it's all gone. Like no one ever says you're too small at 10 million of SaaS revenue and above. So growth is obviously a factor. Having 10 million of revenue but not growing or negative is a real detriment to value. Profitability, and I would make the disclaimer that's pre-shred. So buyers, we see a lot. We're a profitable company. You strip out the shred, you're unprofitable. US buyers, which is 90% of the market, usually can't get the same tax credits as Canadians can. So they look at it on a stripping out the shred. So profitability pre-shred is very important. Percentage recurring, we see a lot of SaaS companies that have 40, 50, 60% recurring, and then other components which we would call reoccurring. So clients that keep buying maybe services on top of that, or other non-pure recurring revenue, but it reoccurs. That's worth less than pure SaaS. And then a big component for a lot of SaaS companies, especially if there's a heavy implementation cycle, is the services revenue and implementation revenues. And they trade at a very big discount to pure SaaS revenues. And then the last two factors that we see a lot that are driving value are churn and customer acquisition cost. Very important in terms of lifetime value and just calculating the economics. There's been a lot of money thrown around Google AdWords and everything else, and customer acquisition cost is blown out of proportion. And when you look at that in relation to churn metrics and lifetime value, buyers are doing that analysis and looking very hard at it. Like, is your growth just because you spent so much on marketing and it's just going to churn off very quickly, or is it really sustainable growth that's going to be around? And then the last thing is the addressable market. Buyers are very focused on how big a pool is it and how much can they penetrate it. So that's pretty much it for my prepared remarks, and happy to take any questions.